Economic data for August coming in weak, with consumer confidence and ADP employment among the read's missing expectations. Let's bring in Tom Lee from Fundstrat Global Advisors. Tom, great to see you as always. I mean, to what extent is this bit of a slowdown for this quarter already priced into the market, do you feel like?
I think the slowdown that you're citing is positive for markets because, as you know, over the last 8 weeks, I think markets were really worried about two things. One was the trajectory of the Delta variant and how that could lead to really adverse economic outcomes. And the second was the Fed was really leading towards an early taper. And I think the soft readings that we're getting in the past couple of weeks is pushing the Fed off. And I think the Delta variant concerns have actually made the Fed dovish too. So as you know, pre-pandemic, the adage was always good. Weak data is good news because it made the Fed dovish. And I think that's where we are today, that if we get soft side readings, it's actually bullish for stocks.
And you think particularly bullish in the short term going into later this month?
Yeah. We think we're in an environment where we're going to see an everything rally into the end of the month. I know a lot of people think September is seasonally weak, but positioning was already quite bearish into the start of September, whether you're looking at the VIX, which spiked in August, or the rapid liquidations by retail investors over the past few weeks. Investors were bracing for sort of a weak final few quarters of the year. And because of that positioning and the Fed turning dovish, I think we're in a sort of reversal of that. And I think investors will get quite optimistic into the end of the month. And that's really the fuel for the rally.
Little bit more, because if softer readings might actually be good in terms of Fed policy, I mean, it looks like you favor energy and materials right now. Why? They're
really the tip of the spear in the epicenter trade. Oil got clobbered starting in June as we started to see the Delta variant surge. I mean, oil went from 77 to 62, and now oil's decisively back above 70. Wall Street firms like Goldman think we could even get to $80. Well, there's going to be a really big tracking catch up with energy stocks because energy stocks have underperformed this move in oil. So I think energy is a good risk reward into year end. And then materials that really, I think, benefits from the supply chain tightness. And the third group we like is FANG. Part of it is the everything rally, but also as investors come back into equities, I think they're going to go buy things that they're comfortable with, which tends to be FANG.
So Tom, ultimately, is your argument for reasons why you're bullish that we're only 1 year into the start of a totally new cycle? Does that still apply even when all of the stimulus is removed a year or so from now, or maybe a little further? Is it reliant on stimulus, or is it not, because it's a long new cycle ahead?
I mean, the future's uncertain, Wilfred. So I don't know what 2022 looks like, but it would be rare for a stock market to peak only 12 months into a new business cycle. As your guest earlier, we're talking about like Stephanie Link, there's a CapEx cycle coming because companies were hesitant over the past year because of COVID. There's a lot of capital stock that's been depleted. So not only do we have an inventory cycle coming and a reshoring of capital assets in America, but if there's infrastructure plus a capital spending cycle, these are all supports for markets. And it's not necessarily dependent on the Fed. But, I think it's going to be tough for markets when the Fed begins to taper. So I'm not saying the markets can look through the Fed tapering in the short term.